Welcome back to Investing Talk podcast. Today, we are really immersing ourselves in the renewed commercial space race. We're looking squarely at intuitive machines.
That's right. It's a name that, well, it just keeps popping up when you look at who's seriously aiming for the moon. And really, the core question we keep hearing from you, our listeners, is this. Is intuitive machines a good time to buy right now? So today, we're going to strip down their competitive position, analyze those financial risks because they are significant, and zero in on the key moments coming up late this year and into early 2026.
Right. Our mission here is to cut through all the space industry buzz. We want to give you the essential nuggets, the things you absolutely need to know about this company's outlook for, say, the next 12 months or so. Before we jump right in, just a quick reminder, please do subscribe, like, and comment on this analysis. And hey, if there's a specific company you want us to examine next, please just leave that name or ticker in the comments below. We definitely look at those.
Okay, let's get started. Let's talk about the real pull of their core business.
What makes intuitive machines stand out? I mean, there are dozens of space stocks floating around now. When we look at the source material, what's the single unique advantage that justifies, well, the high valuation and, frankly, the high risk?
It really boils down to strategic dominance achieved through execution. Intuitive Machines has managed to establish the first and only proven commercial lunar landing capability. That's the headline. And this isn't just, marketing speak. It's a real operational track record. And crucially, this success is under the umbrella of NASA's Commercial Lunar Payload Services Program, CLPS.
Okay, CLPS. Why is that certification such a big deal, such a formidable barrier? Couldn't, a SpaceX or some other massive aerospace player just throw $1 billion at it and say, okay, we'll catch up next year?
That's exactly the right question to ask. And the market should be skeptical. But the reason this moat, this advantage is actually quite deep is twofold, really. First, there's the sheer technical difficulty. Space is hard. The moon, even harder. Just proving the tech works. Surviving the journey, the navigation, the landing sequence. It's incredibly complex. It takes years of testing, failures, learning.
Okay, so the tech hurdle is real. What's the second part?
The second part is the regulatory hurdle, NASA certification. It means they're a known quantity to NASA, a trusted partner for the Artemis program, which is ramping up. Think of it less like trying to have one fast car in a race. It's more like building the very first successful transcontinental railroad. Once those tracks are down, and the government verifies your route, you become the default choice, at least initially, for all the immediate traffic. That first mover advantage is just massive, and it's incredibly hard to replicate quickly, even if you have deep pockets.
That does sound like a powerful argument for their long-term strategic value. And we are seeing some revenue validation already, right? Trailing 12-month revenue hit about, $226 million. It shows the model can work.
Precisely. $225.98 million to be exact. It proves people will pay for this. But you're right to point out that it's still heavily mission-based revenue. So the question becomes, how do they smooth out that lumpiness you get with government contracts?
Yeah, exactly. How do they ensure they aren't just waiting for the next big NASA award?
Well, they're being quite strategic, actually. They're aggressively moving into what they hope are high-margin adjacent areas. They know missions are irregular, so they're building or planning to build other revenue streams. This includes things like specializing in space networking, lunar surface mobility, think rovers, and maybe most interestingly, developing re-entry vehicles.
Re-entry vehicles? Okay, that sounds like a jump, especially for things like biopharma or semiconductor transport. That's not just dropping payloads on the moon. What's thinking there?
Yeah, it's a fascinating angle. And the simple idea is that manufacturing certain things in microgravity is highly valuable. You can, for example, grow near-perfect semiconductor crystals or specific biological compounds without Earth's gravity messing up the structure. The results can be far superior to what's possible down here.
Ah, okay. So the value is in the return trip.
Exactly. If intuitive machines can offer a reliable, certified way to bring those high-value, space-manufactured goods back to Earth safely, well, then they tap into a completely different, potentially very high-margin industry. It dramatically diversifies their customer base way beyond just NASA. And then there's the longer-term potential, maybe even lunar nuclear power systems. That's another layer of this sort of infrastructure play they seem to be building.
Okay, let's unpack this a bit, because if they have this clear first mover advantage, this moat, why does the balance sheet look, well, frankly scary? We have to talk fundamentals, specifically the losses right now.
Yeah, we absolutely have to address the cash burn. It's significant. Look, this is a capital-intensive business. Aerospace, especially in the scaling phase, requires enormous upfront investment, R&D, infrastructure. It all costs a fortune. So Intuitive Machines currently reports a trailing 12-month net loss of minus $241.76 million. That translates to a loss per share of about minus $2.56. That's definitely a number that gives many investors pause.
Minus $241 million. Wow. Yeah, that sounds less like scaling and more like a hole in the hole, as they say. You really have to have some patience, some conviction to stomach that kind of loss.
You absolutely do. But, you almost have to view it as the cost of admission to build this LUNR economy. That money is being poured directly into strengthening that moat we talked about, developing the next lander, improving the software, building out those other potential revenue streams. And crucially, the trajectory is the signal to watch here. The forward projections, the analyst consensus, show a massive improvement coming.
Yeah.
Next quarter's earnings per share, the EPS, is expected to shrink dramatically to just minus 0.45 cents.
Minus 4 cents. From minus $2.56. That's a huge swing.
Exactly. While at the same time, revenue is expected to accelerate to around $68 million for the quarter. So the story is, losses are expected to stabilize, maybe even shrink rapidly, while the top line, the revenue, is growing fast. That suggests those big investments are starting to shift from just being expenses to actually generating recognized revenue.
Okay, so we've got a company currently valued around $2.13 billion market cap, and a stock that's known for being, well, pretty wild.
Oh, the volatility is undeniable. The stock's beta is 1.41. For you listening, that basically means if the broader market moves 1%, this stock tends to move about 1.41% in the same direction, often more, amplified by specific news. So if you're a patient long-term investor, this volatility can actually create good buying opportunities when the stock pulls back on, say, unrelated sector news or temporary setbacks.
And for a trader.
For a shorter-term trader, it offers enhanced leverage, both up and down, when those positive or negative catalysts hit. Let's be clear, this is definitely not a stock for someone looking for stability or low risk.
Right. Which brings us neatly to those immediate drivers, those catalysts. What are the upcoming inflection points, the things that could really trigger that volatility over, say, the next 3 months? Maybe look back quickly first. What were the key signals we just got?
Yeah, the last few months were actually a perfect illustration of this stock's risk-reward profile. In October, we got some reassuring news about progress on their NASA CLPS contracts. That helped solidify confidence in near-term revenue. But rewind to August. Remember they had to confirm a technical delay on their next lunar lander mission. Some software validation issues.
Oh, yeah, I remember that. That hit the stock pretty hard, didn't it? Led to some analyst downgrades.
Instantly, it caused a sell-off, downgrades. A sharp reminder of the inherent mission execution risk. Space is unforgiving.
But wasn't there something else during that dip? A signal about management's own confidence.
Ah, yes. Very important point. Amidst that August sell-off, there was notable heavy insider buying disclosed by key executives. Now, for a regular tech company, insider buying is, nice to see. But here, I think it carries more weight. When a technical setback happens in a space mission, it's a real physical engineering problem. It's not just a software glitch you can patch overnight. So when executives put significant amounts of their own capital on the line after that kind of news breaks,
they're betting on their engineers to fix it.
Exactly. They're betting personally that their teams can solve that complex physical challenge, that the delay is temporary, not fatal. That signals, I think, a very deep conviction in the mission's ultimate success and the company's long-term value.
Okay, interesting. So let's turn the calendar forward now. What are the absolute pivotal dates investors need circled, maybe in red ink, between now November 2025 and, say, January 2026?
All right, mark your calendars. The big one, potentially shifting the whole narrative, is November 14th, 2025. That's the Q3 2025 earnings report. Everyone will be scrutinizing revenue recognition, cost management. Basically, we need to see if that predicted big drop in loss per share actually happens.
So proof of the improving trajectory.
Precisely. Then, something maybe less fundamental but still relevant for trading is November 30th, 2025. That's a Russell 2000 ETF rebalancing date. It can sometimes drive significant short-term trading volume in smaller cap stocks like this.
Okay. And then moving into the new year.
Couple of key government-related dates. January 6, 2026 is typically when NASA releases its holiday progress report. Sometimes contains important updates on funding or specific CLPS mission schedules. Worth watching. And then, the real forward-looking guidance comes on January 22nd, 2026. That's when the company is expected to provide its fiscal year 2026 guidance and lay out key mission milestones for the year ahead. That's the date that lets analysts really update their models and price targets for the full year. Got it. So, hard dates to watch. But beyond that, we can't ignore the background noise, the rumors that often drive sentiment in these kinds of stocks. What's the most persistent, maybe highly speculative buzz floating around right now?
Yeah, the buzz is definitely high, mainly because they have that verified lunar access. It makes them a logical partner. So speculation often centers around a major potential commercial partnership, maybe with a big flagship satellite operator. A deal like that would instantly validate their non-NASA revenue strategy.
Okay, that makes sense. What
There's
else?
also sometimes chatter about potential M&A interest. A large established aerospace prime deciding it's easier to buy Intuitive Machines' proven lunar tech and IP than to build it themselves from scratch. Now, as always, you have to treat these kinds of rumors with extreme skepticism, very carefully, but they do illustrate the level of strategic interest this company generates because of its unique position.
Okay, let's shift gears slightly to the technical picture and what the analysts are saying. Yeah, what's fascinating here is despite all that volatility we talked about and the cash burn, the stock has actually delivered a strong one-year total shareholder return, about 41.7%. So the market, at least over the medium term, seems to be rewarding this competitive position.
And the technical setup, the charts, do they confirm that underlying belief right now? Where does the stock actually sit compared to, say, recent history and what analysts expect?
Well, right now, the stock is trading somewhere near, let's call it $12.88 to $13.09. That's significantly below its 52-week high, which was up near $25. So there's room to run if the news flow is positive. Looking at the charts, technical analysis seems to suggest that for the next 3 months, we might be looking at a generally bullish trading range between, say, $12 on the low end and maybe $18 on the high end. And that November 14th earnings report we mentioned, that's likely the primary trigger that could test that upper boundary around $18.
Okay, $12 to $18 range potentially. And what about Wall Street analysts? How confident are they in this name, given all the risks we've laid out?
The conviction is actually remarkably strong, considering the volatility and the current losses. We looked at, I believe, 13 analysts covering the shock. Fully 9 out of those 13 rated as a buy. That's pretty solid consensus. The average price target right now is around $15.44. That suggests what, about a 24% upside from where it's trading today?
And the highest targets.
The most aggressive bulls on Wall Street have targets up at $20 per share. That implies, a potential 62% gain if everything goes right. So that strong institutional faith, I think, confirms that they believe the execution risk, while real, is manageable compared to the potential reward of owning the first mover in commercial lunar logistics.
And we probably shouldn't forget the sort of positive vibes spilling over from the broader space sector, right? That helps validate the whole business model. Things like recent successful tests by competitors, maybe SpaceX's Starship, plus big finance stepping in, like JP Morgan announcing that new $10 billion space industry program.
Absolutely. It reinforces that this whole ecosystem is shifting from, science fiction to a scalable commercial reality. And Intuitive Machines is arguably perfectly positioned right at the center of that growth. They're effectively building the toll road to the moon just as the traffic is starting to pick up.
The toll road for the moon, I like that. Okay, so let's try to tie this all together. We've got this massive first mover advantage, strong belief from analysts, key catalysts coming up, but we need to be balanced. Where are the main hurdles? What could actually derail this bullish story?
Right, the risks. Number one, without a doubt, remains mission execution risk.
Yeah.
We saw in August what even a minor technical delay can do to the stock. If any mission were to actually fail after launch, well, the impact on the share price, their ability to raise future capital would likely be immediate and severe. That inherent technical complexity is the absolute core company-specific concern.
Okay, mission execution risk is number one. What about external factors? Things maybe outside their direct control.
Well, you definitely have to highlight customer concentration. Right now, their revenue is still highly dependent on NASA and government contracts. Now, the Artemis program seems to have strong political support across the board, which is good. But budgets can change, priorities can shift. A significant cutback in CLPS funding down the line would absolutely be a major headwind for them. And finally, linked to that is the ongoing high capital requirements. They need constant access to capital markets selling stock or taking on debt to fund future missions. That makes them sensitive to overall market conditions, interest rates, and just general investor appetite for risk.
Okay, so mission risk, customer concentration, capital needs, those are the big three hurdles. But as you said earlier, we circle back to the mitigants for those risks. The fact that they have actually landed successfully, they're the only commercial entity to do so. Plus their clear strategy to diversify into those other areas like re-entry vehicles and networking. That's their explicit defense against these risks, isn't it? Trying to build some stability into what is fundamentally a pretty unstable sector.
That's exactly right. They seem to be consciously trading some short-term volatility and high spending for what they hope will be long-term strategic dominance in the lunar space.
Okay, that brings us to our final assessment then. Based on everything we've discussed, the proven execution, that expected sharp improvement in financials, the strong Wall Street backing, we're assigning an overall bullish rating of 8.5 out of 10 for Intuitive Machines right now.
Yeah, an 8.5 feels about right. And for you, the listener, I think the key takeaway really needs to be tailored to your own investment horizon. If you're focused on short-term trading, maybe looking at just a few weeks or months, then yes, this stock looks highly attractive, especially heading into that potentially pivotal November 14th earnings report. That's a massive near-term catalyst.
And for the longer term view,
If you're a patient long-term investor, someone willing to ride out the inevitable volatility, then this stock looks highly compelling. Because fundamentally, you're buying into what looks like a multi-decade structural growth trend, the rise of the commercial lunar economy.
it really does feel like the ultimate infrastructure play for this next generation of space exploration.
It does. And maybe here's the final, really provocative thought to leave you with. What happens if their commercial footprint eventually goes way beyond just delivering payloads? Think about the truly speculative but potentially enormous long-term opportunity. What if that market chatter, those rumors about commercial lunar mining partnerships or using lunar resources right there on the Moon ISRU, they call it, what if that starts to materialize in the coming years?
Using moon rocks for fuel or construction.
Exactly. Intuitive Machines, with its established, proven, certified access to the lunar surface, they become arguably the only logical commercial partner for any company looking to actually unlock those future resource extraction economies. We're talking potential billion-dollar opportunities over the next decade. That is the really spectacular, though still speculative, upside that you're ultimately investing in today.
Potential $20 stock today, but maybe a foundational partner in a $200 billion lunar economy tomorrow. Something to think about. Thanks for joining us for this analysis of Intuitive Machines. We'll see you next time on Investing Talk Podcast.